Hello, everyone. Welcome back to another episode of the Weekend Charts. I'm your host, Charlie Bilello, bringing you the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a quick moment, hit that subscribe button for more content just like it. We have a huge show today, a lot to talk about. Global trade chaos, recession talk, the U.S. manufacturing, a lot of focus there. Do we make anything anymore? The Mag 7 revaluation has been the big story in markets so far this year, along with markets questioning U.S. exceptionalism. The golden age for gold ripping higher, one of its best starts to a year in history. We'll talk about the housing market, and we'll end, as we always do, with something positive. That will be the transition in terms of the U.S. consumer from goods to services. Okay, let's start out. Global trade chaos. I don't want to spend too much time on this because the news is changing hour to hour, and it seems like whatever is the case today, tomorrow it will be reversed or there'll be something different. But this is just one example of that here. We got this exemption last Friday for phones, computers, chips out of China. And then this was a Friday after the close, and not even a day later, you start to see them walking this back, saying that wasn't actually the case. It's going to be a separate tariff for this category of goods that's coming soon, is coming from Howard Lutnick, and then President Trump saying there was no tariff exception announced. They're still subject to the 20% fentanyl tariff. So confusing, complicated, likely to change all of it from day to day. I wouldn't put stock on any of it. Nobody knows how it's going to shake out. I think the important thing as we end this week is that there hasn't been any major deal announced with any country, never mind China, which is going to be the most complicated and probably the most drawn out. But no deal announced with any country. I think that's surprising and probably why the S&P 500 ended the week down despite some of this good news in terms of these exemptions at the start of the week. And then you had this other development with NVIDIA taking a $5.5 billion charge to their first quarter results. And they did so because you have this new license for exporting processors to China and other countries. So they're being restricted. And they're saying because of that, it's going to be a $5.5 billion hit to their earnings. So not a small amount. NVIDIA stock was already down on the year by a good amount, and certainly that this didn't help that. The idea there's going to be not only tariffs increasing on imports, but also restrictions on exports. This was already going on under the Biden administration, but this appears to be something new added to that in terms of what they can actually export to China. And Ryan Peterson had a good thread on X. He is the founder, CEO of Flexport, it's a logistics company. So he has a good read in terms of what are all these policies going to do to the supply chain? What impact are they going to have on small businesses that obviously rely on manufacturing abroad and rely on buying inputs to their businesses abroad? And what he's saying is that thousands and then millions of American small businesses, including many iconic brands, will go bankrupt this year if the tariff policies in China don't change. Now, I don't think anyone believes that they won't change, that they're going to remain at these crazy levels. I think everyone believes they're going to be lower, but forget about the millions. Are we going to start to see an increase in bankruptcies if this situation isn't resolved in short order? And it seems likely that we will for companies that can't very quickly transition away from China and find a place to manufacture those same goods at a similar quality and a similar price. So if they simply can't just flip a switch and move to another country, let's say like Vietnam, if they can't do that, well, what's going to be the impact on that business? Obviously, many of these businesses, if they were to pay those ridiculously high tariffs, well, they would no longer be profitable. And what he's saying is these brands are going to fail, and actually the Chinese factories who are making these goods are going to buy basically that brand in bankruptcy. Now, who knows if that's going to happen? What I'm focused on is the supply chain in the short run. Is it already being impacted? And it seems like it is. He's saying that ocean freight bookings from China are down 50% in the week since the tariffs hit. And that's obviously a huge, huge number if true. And it won't take long, I don't think, to see this cause problems in the supply chain as we saw during COVID. There's going to be a backlog and a buildup in terms of we're not importing these goods. You can't then all of a sudden create more freights to bring in these goods in the future. Well, there's going to be a backlog. What is that going to do in terms of shortages? What is it going to do in terms of prices? We haven't yet seen that impact. And so that's something to watch very closely, is the freight numbers coming out of China and other places, because it seems likely that even if you believe that the number is going to come way down, there's going to be deal, let's say 3 weeks from now or a month from now, you're probably going to go on a buying strike for the time being, because you're not going to pay these high prices if you think that they're going to come down in 3 weeks' time. You can't do it. You probably can't do it to make a profit on it, but you still wouldn't do it as a financial decision, because you think it's going to be lower a few weeks from now. You think it's going to be changed, or maybe even a day from now, as we saw with the exemptions that were announced for the phones and the semiconductors and other electronics. So a lot of uncertainty continues here until we have some resolution. I think in terms of the financial markets, you have to expect just continue high levels, above average levels of volatility, because people are going to be wondering, is this going to cause a self-inflicted recession? So if you look at where economists were entering the year, only 22% probability in this Wall Street Journal survey that the U.S. economy would enter a recession in the next 12 months. So very optimistic entering the year. For sure, they did not anticipate any of this situation going on with the tariffs. But in a poll last week, that jumped to 45%. And I suspect if this continues for a few more weeks, it'll be well above 50%. And so many are saying, well, this is not an external force causing this. This is going to be a self-inflicted recession, because we're imposing these tariffs, we're restricting global trade because of that, and that's going to cause the U.S. economy to go into a downturn. And perhaps we could see that pretty soon. If we look at first quarter real GDP, the estimate from the Atlanta Fed is that we're going to see a 2.2% decline in the first quarter. When do we get that information? Well, that's going to come out at the end of this month on April 30th. We'll get the first read in terms of first quarter GDP, and usually not a lot of attention in terms of this number. I think that's going to be very different for this number. A lot of focus is going to be on it. And you could see here the trend down in terms of the blue chip Wall Street economists, their projections. You could see they've been coming down. They were above 2%. Now they're below 1%. And by the time we get to that report, maybe they'll be expecting a negative number, but that doesn't seem to be the consensus just yet. And what's causing that negative forecast? It's really all in that net exports number. So it's really all in the idea that during the first quarter, companies were really pulling forward their imports of goods in anticipation of the tariffs, and that's going to lead to this decline in real GDP. But if you ask the average person, they're not going to be concerned so much about this technical recession, because the net export number isn't impacting their job, it isn't impacting their wages yet. They're going to be more focused on these other numbers, which are still going up for now. Consumer spending is going up, non-residential fixed investment contributing positive. So the estimate for everything else other than the next export still positive. So the big question is going to be for the U.S. consumer, since the U.S. economy 70% dependent on consumption on the U.S. consumer, is the U.S. consumer going to start to pull back because of all this? And as we said last week, if you look at the survey data, that would suggest very much that the U.S. consumer is about to pull back. We just haven't seen it yet in the actual hard data. And we got retail sales this week report for the month of March, but this was before the tariffs are in place, so you can't read anything into it. But for the month of March, it showed a year-over-year increase of 4.6% on a nominal basis and 2.1% adjusted for inflation. So relatively strong number for the month of March. But again, that was before the tariffs. And some people are suggesting, well, consumers as well as corporations kind of pulled forward their purchases, expecting prices to rise. And if we talked about last week what the expectations were in the same survey for inflation, and it was U.S. consumers are now expecting over 6% inflation over the next year, one of the highest readings we've seen since the early 1980s. And so if you're expecting prices to rise, what you do, if you're going to buy something, you'll buy it today instead of tomorrow if you're expecting a big price hike. So some people are saying that filtered into this number. So it'll be interesting, obviously, and important to look at the April data in terms of consumer spending. Are we going to see a pullback that really aligns with this sentiment? Or is it just people feeling very bad because of all the negative headlines, because of the anticipation that perhaps we're going to recession, but they haven't yet actually changed their spending habits because they still have a job, they're still employed. And if we look at that employment picture here, you have kind of two different ways to look at it. One, looking at obviously the government sector and the layoffs we've seen there. That's one story, and that's really driving this huge increase in layoffs this year. So 497,000 job cuts were announced from January through March, and 56% of that, so 279,000 of those jobs were just coming from DOGE. So if you strip out the federal government job cuts, it looks pretty much like it looked a year ago. And if we look at jobless claims, we're not seeing a spike higher. So we're not seeing people file for unemployment. Even those government jobs that were lost, we're not seeing it yet, probably because they have a long severance period, or perhaps even they found a job in the private sector. In any case, we're not seeing it in the actual data just yet. And during recessions, you tend to see this trending higher and trending higher aggressively. So it doesn't seem yet to be the case that people are losing their jobs en masse because of this. But this will be the number to watch. This is the closest read to a real-time data point that we get on the jobs market. And then talking about the financial markets, are they pricing in a recessionary scenario today? I would say very much no. If we look at the credit markets, they did spike to 461 basis points in terms of high yield credit spreads last week, but you can see that's not even at the historical average, and it was coming off of the lowest spread that we've seen since 2007. So investors were extremely optimistic just a few months ago in terms of there would be very few defaults. And now that default risk has gone up, but it's not even at the historical average today. And if you look at other periods where there were big stock market declines, big corrections, and recessions, we're lower than all of them today. So I'd say looking at the credit markets, definitely not pricing in a recessionary scenario today. So if you think there's going to be a recession, what you would argue is we need to see more pain in the financial markets to really adjust to that reality. The last three recessions in the U.S., we saw high yield credit spreads go over 1,000 basis points at one point in time or another. So if we're going to see a recession, more bankruptcies, more defaults, you should see high yield spreads move up. If we get some type of big deal in terms of the tariffs in the next week or two, and that really causes uncertainty to go way down, perhaps last week was the worst it could get. So obviously a lot dependent, more so than usual, on the incoming news and what's actually going to happen with this tariff scenario. And I don't think anyone really has the answer. I guess unless you're in the inner circle of the White House, I'm not sure how you could really handicap what's going to happen with all the different countries. There's just a huge range of possible outcomes. It seems likely that the outcomes will be better than where they stand today overall if we're looking at, let's say, 3 or 6 months from now. But how much damage are we going to cause to the economy in the short run? And what is the probability of kind of that tail risk scenario where we have elevated tariffs, even if it's just on China for a period of time, and that causes pain, that causes bankruptcies for more companies than anticipated? Okay, let's talk about this statement here, the US doesn't make anything anymore. You've probably heard this saying, you hear it all the time. And I think a big part of it is just simply we're not involved in the manufacturing sector as a country nearly as much as we were in the past. This is looking at the US manufacturing jobs as a percentage of total jobs. And you can see in 1945, we were at 45% of all jobs were in the manufacturing sector. And today we're down to 9%. And clearly, with the unemployment rate not much higher than its all-time low today at around 4%, clearly we were able to replace these manufacturing jobs with jobs in the service economy. But this huge decline in terms of the manufacturing sector's importance in terms of our everyday jobs, I think is leading to the perception that we don't make anything anymore. But if you look at the actual data, if you look at industrial production, and this is inflation adjusted, so it's a real index. So after inflation, what is the output in terms of US production? It hit a record high in February of this year and substantially higher than where it was decades ago, certainly multiples higher of where it was in 1939. So what's going on? How are we able to produce so much more when such a lower percentage of our population is involved in the manufacturing sector? Well, we're much more productive. So many of the US factories are more automated today. The average worker is simply much more productive than it was decades ago. And that's been a great thing, obviously, for the US economy, being able to produce so much more with fewer people doing it. Now, this is the big question, I think, in terms of the global imbalance. Are we likely to change this very much? Should we try to change it? How much should we change it? But clearly, there's just a huge imbalance if we look at the US and China in terms of consumption and manufacturing, where in terms of global consumption, the US is about 29% and China is at 12% of global consumption. But in terms of global manufacturing, China is at 32% and the US is at 15%. So some have argued this imbalance, which is obviously creating a trade deficit for the US as well. In terms of the US and China, some have argued that this justifies having tariffs or renegotiating trade deals. And it would be hard to argue that this imbalance shouldn't be reversed somewhat. The question is, well, how much time to get to that place, and what are going to be the economic ramifications once you do that? And how do you force a country like China to consume more? That's a very complicated question. Obviously, it's not just a tariff situation in terms of China. They're restricting many of our goods, our services. Obviously, Google's not allowed in China, and Meta and many other companies aren't allowed to do business at all in China. How do you rectify this in terms of consumption of the US and China and the world? And if you are trying to bring the US consumption down, and in part this high consumption from the US is due to the deficits that we have as a country, what is that going to do to the global economy? So very complex question. No question there's a huge imbalance. No question it probably should be moved a little bit in the other direction to just create more stability and balance. And people have talked about encouraging China to become more consumption driven in terms of their economy. But how you actually get there and how quickly you get there, and do you want to get there in terms of what will this actually do to the average person? Is it actually a good thing? Should you have it equal? Should it be like the Eurozone where it should be 100% equal? I don't think anyone has the answer to that question. I just know that if you try to get there overnight and that's your goal, is to try to change this imbalance overnight, it's going to cause massive, massive pain for everyone. So hopefully that is not the objective. Okay, let's talk about the Mag 7 revaluation so far this year. Biggest story in markets, in my view, in terms of the equity markets, is the fact that the Magnificent Seven names, NVIDIA, Meta, Tesla, Amazon, Google, Apple, and Microsoft all underperforming the S&P 500 this year. You could see some of the losses pretty big. Tesla down 40%. Obviously, Nvidia 24% being the darling for years. Last year, it was up 171%. And obviously, the year before that, up huge as well. So all of these companies in the Mag 7, if you look at the last 10 years, outsized performance versus the S&P 500 versus the equal weight, so the average stock in the S&P 500 and versus international stocks. Huge spread with these companies outperforming. And part of that was fundamental. So part of that was simply the earnings of these companies have grown far faster than the overall S&P 500 and far faster than the rest of the world. But there was another part as well. It wasn't just fundamental that I've talked about. It was also sentiment driven. So you had a valuation expansion in terms of the price to earnings, price to sales for all of these companies over the last decade above the level of earnings growth. So it wasn't simply Apple's making 100% more and its stock has gone up 100%. No, Apple's making 100% more and its stock has gone up 1,000%. So we've seen a multiple expansion, enormous over the past decade and the past few years. That really accelerated to the upside. And entering the year, if you look at the valuations of some of these companies on a price to earnings basis, Tesla at 198 times earnings, Nvidia 53, Apple 40, Amazon 40, Microsoft 34. It's hard to argue that these companies weren't priced for perfection. And so far, all we've seen is a little bit of a reversion back to the mean, but not at the mean whatsoever. If you're looking at a company like Tesla, still at 118 times earnings, Nvidia still at 35 times earnings, Apple 31, Amazon 31, Microsoft 30. If you look at the S&P 500 overall, it's gone from 28 to 25, so certainly better, but nowhere near its historical average in terms of a price to earnings ratio. And Apple, I think, is an interesting one to look at. Obviously, biggest company in the world entering the year, and you had it trading at 10 times sales, highest in history in terms of Apple. Never traded at a higher multiple of sales. And that wasn't because Apple was growing very fast, growing faster than ever before. So it wasn't simply forecasting higher sales growth to come. A lot of the argument was, well, it's because Apple's margins are very high and they're going to stay high forever. And I think this tariff situation and the situation with China and the fact that Apple obviously relies on China for a lot of its manufacturing, and the fact that the iPhone costs what it does because it's getting a cheaper manufacturing in China, well, that helps the bottom line of Apple in terms of its margins. Well, that's been called into question with this situation for sure. It's definitely been one of the factors driving down its valuation today. It's still at 7.6 times sales, definitely not cheap. I mean, only a few years ago in 2019, it was trading at its historical average in terms of a price to sales at 2.8. So you could see it's still multiples higher than that. It's just come down a little bit in terms of the expectations were at a record high entering the year, and now they're at, I'd say, a more realistic level, but still no one could argue at 31 times earnings and 7.6 times sales that Apple investors are pricing in anywhere near the worst case scenario. So we're definitely, for all of these stocks, not pricing in an earnings decline. We're not pricing in a recession in the US, which would hurt the demand for things like getting a new phone, which might push out if you lost your job or the economy is weaker. Nobody is pricing that in yet for any of these stocks. So here's the next question. Are markets questioning U.S. exceptionalism? And I asked that question because the U.S. for years was the best performer by far over in the world. It was outperforming the rest of the world for 16 years, the longest period in history entering this year. And this year we're seeing the reversal of that with the S&P 500 down a little over 10% in the first 73 trading days. One of the worst starts we've seen, fifth worst start to a year in history. And really, except for the 1930s and 1940s, we had Depression, World War. With the exception of that, Only 2020 was worse at this point in time during the COVID crash. You can see it's a mixed bag in terms of starting off the year bad. It doesn't have to continue to be bad. Look at the top four here; all of them reversed and had big gains from this point to the end of the year, but not every time. Obviously, 2008 being a counter example. 2022, most recently, stocks were down and they continue to go lower throughout the year. But in terms of the S&P 500's decline, we've seen not just the S&P 500 go down, but we've seen volatility really increase, and it was really shocking because last year was such a mild year. We only had 19 days in all of 2024 where the S&P 500 was down more than 1% in a trading day, and we're in mid-April here, and we've already had 18. So we're almost matching that by April, the middle of April, what we did in all of last year in terms of volatility. And of course, last year, 57 all-time highs for the S&P 500, averaging one every week. And this year, S&P 500 in a bear market. But let's get back to that American exceptionalism. Our market's questioning it. You can see the huge divergence here between U.S. markets, and if you look at small caps, the worst in the list here, which is interesting because small caps were underperforming for over a decade heading into this year and continuing to underperform. So really the most sensitive to the U.S. economy would be U.S. small caps. They're doing the worst. Then you have large cap growth stocks, so the Mag 7 names. Then you have the S&P 500. Then you have value outperforming, but still down, U.S. value. U.S. REITs down a little bit. Emerging markets close to flat, down a little bit. But then you go on the upside, you got international bonds, U.S. bonds up 2%, and you have MSCI World ex-U.S. up 4.8%, international real estate 6%, and international developed stocks 6.6%. So huge, huge spread. One of the biggest, if this holds, this will be one of the biggest spreads we've ever seen for a calendar year in history in terms of international outperforming U.S. if this holds. And what's been fascinating is to look at this picture here in terms of global equity returns, because 2/3 of these names are actually positive. So as much as it's been a terrible start for the S&P 500, if you look at a country like Poland or Spain or Greece, it's been a phenomenal start to a year for many of these countries. If you look at Eurozone, up 13%, EAFE equities 7%. As we said, MSCI World ex-US 4.8%. So it's really U.S. stocks at the bottom of the list for the first time in a long time. And if we look at this asset class return mix here, you can see the spread, U.S. small caps at the bottom, gold, which we're going to talk about a little bit at the top, but internationally doing very, very well. If you're looking at EAFE stocks, you're looking at bonds overseas, you're looking at real estate overseas, all doing very well. And part of this is getting back to that mean reversion that we just talked about for the Mag 7. So is it the markets questioning U.S. exceptionalism, or is it that the markets were overly optimistic about that exceptionalism continuing? That is the real problem. So what I'm showing you here is the CAPE ratio, so valuation, looking at 10-year earnings, average earnings. And entering the year, you had the U.S. trading at nearly 38 times for this CAPE ratio, and Europe at 20 times. And this spread, as I mentioned at the time, highest in history. So highest U.S. premium in terms of valuation in history, 86% above Europe. So U.S. price for perfection, its valuation was exceptional. So the idea that the U.S. was going to continue to dominate in terms of growth, outperforming Europe, in terms of profits, outperforming Europe, in terms of everything doing better, well, that was pretty much fully priced into the market at that point. So you needed additional good news to push it higher, this valuation, and we didn't get that. We've gotten so far the idea that perhaps the U.S. is going to have a recession this year, that we're going to see a hit maybe to profits this year, and that's putting compression in terms of this valuation. So if I come back to this chart because I think it's one of the most important ones that doesn't get a lot of attention, This is the CAPE ratio at the start of each presidency, going back the last 100 years in the US. And you can see Trump's second term here, we started with the highest valuation of any president to start. And number two was George W. Bush, and he was one of the few presidents who actually had a negative return in terms of the stock market during his presidency. So what we're talking about here, yes, tariffs, definitely a concern. A lot of different concerns of what's going on and what's going to happen in terms of the economy and everything else. But the U.S., a bigger problem was that the U.S. wasn't trading at an average valuation or a cheap valuation heading into it. It was trading at its highest valuation ever of any start of any presidency in history. So it was priced for perfection. And what we're seeing so far this year, obviously, is not perfection. And what's adding to this questioning of U.S. exceptionalism and is actually helping with the international equity returns that I just showed is the fact that the dollar is not going up as it had been for many of the prior years. It's actually going down and going down pretty fast here. Over 8% decline in 2025, which is its worst start to a year since 1995. And I just listed a bunch of the major currencies around the world and the dollar's return against those currencies. So it's lost 3% against the Aussie dollar, 3% against the Canadian dollar. And you can see Mexican peso down 4%, real from Brazil down 5%, euro down 8%, yen 9%. Even the Russian ruble, the U.S. has lost 27%. U.S. dollar has lost 27% of its value. So if we look at year to date here, only 1995 had a worse start for the U.S. Dollar index than this year. So clearly, whether it's flows coming out of the U.S., a lot of people have suggested that the foreign inflows were huge in terms of investment in the past few years, and now there's been a pullback, or whether it's the U.S. investing abroad that's causing this to happen. I think there's obviously many different factors going on that's driving the dollar lower. And you also have just positioning where people were positioned for continued dollar strength. The dollar had gone up after the election on the assumption dollar is going to be strong. And now we've given that back and then some. So another reason why diversification is important in terms of equities is you're getting that currency diversification as well. So that's helping a lot of these returns. The fact that the euro is higher, the yen is higher, all these currencies are higher, you're getting that return as added to your return when you're investing in international equity. So if you're thinking about what to do as an investor today, reach out to us today at Creative Planning. We're here to help. Go to creativeplanning.com/Charlie to get your free wealth path analysis. We're in all 50 states, so we likely have a location right near you. Over 350 billion in assets under management and advisement. Reach out today, creativeplanning.com/Charlie. So next, let's talk about the golden age for gold. And I want to show you this chart that really stunned me when I was crunching the data here. This is the real price of gold. So inflation adjusted price going back to January 1980 when gold peaked after a historic mania move higher during the late 1970s. And you can see here it's been 45 years, but now we're finally back at an all-time high adjusting for inflation. So what this chart should tell you, first of all, is that gold, far from a perfect inflation hedge. There is no perfect inflation hedge, but gold certainly is not it. If you can go 45 years and not keep pace with inflation, it's probably not a very good hedge. And certainly during this period, 20-year period where there was a lot of inflation from 1980 to 2000, gold not only did not keep pace with inflation, it was actually at a lower price. So forget about adjusting for inflation. The price of gold was lower in 2000 than it was in 1980. But here we are today, new all-time high in terms of the real price of gold. And how did we get to that situation? Well, simply gold going up well more than the inflation rate over the past few years. And you can see this really, you got to start, I think, back in 2019 here, 19% gain, 2020, 24% gain. Then a lot of people questioning gold, had a difficult 2021 and 2022, but then roaring back here, 2023, 13%, 2024, 26%, and this year, 26.7% so far this year, which best start to a year for gold since 2006. And if it were to continue at this pace, it would be second in history behind 1979. So that should just give you an idea of how fast gold has moved so far this year. We're only in the middle of April, already up 26.7%. Needless to say, not likely to continue at that pace. If you didn't, you probably didn't need me to say that, but I'm going to say it anyway. Just an unusually strong move higher for the price of gold. And I thought this was an interesting chart over the last 20 years. Probably would surprise a lot of people that gold is now ahead of the S&P 500 over the last 20 years because of this enormous move higher over the past 2 years. They're close, and both of them have done very well. It would surprise people, I think, because the S&P 500's had a pretty good 20 years, up over 10% annualized during this period of time, and gold just besting it by a little bit. And if we go back to the GLD inception, so the first ETF for gold didn't come out until November 2004. So before this ETF came out, it was much harder to buy, obviously, gold. You could obviously buy coins or physical gold, and there were some mutual funds. You could buy gold miner shares, but this really increased the accessibility of gold at the time in November 2004. But you can see it's been a series of booms and busts, no different than the stock market. In fact, a lot of times inversely correlated in terms of the gold's performance versus the stock market. But the cycle of outperformance really since its inception, the ETF in November 2004, would continue for about 7 years. And then that reversed. Gold had a pretty long bear market after that. I think a lot of people probably forget that at this point in time, where it went down almost 50%. And meanwhile, the S&P 500 was going up and up and up. And then more recently, you have a back and forth, but the S&P 500 strongly outperforming in 2021. And that increased its lead there. In 2022, both of them struggled. But you can see here, gold playing catch up in terms of the past 2 years of performance and racing higher so far this year, with the S&P going down and gold going up. So S&P off to one of its worst starts in history, and gold one of its best starts. Number 7, house rich, cash rich. This is an interesting concept because many people know the expression house rich, cash poor. Certainly not a position anyone wants to be in, where you're putting all of your money into the house. You have nothing left to save, nothing left to invest. Not a good position. But if we look at where people are today, it seems like they're in a good position with both of these situations. With the home equity value, if we look at 35 trillion in the US as of the fourth quarter of last year, that's nearly triple what it was a decade ago. And how is this going up so much? Well, simply home prices are up significantly over the last decade, and home equity is a leveraged concept, of course, because people aren't putting the full amount down. So when you have a big gain that outpaces what you're paying in terms of your mortgage, well, you're getting that leverage effect to the upside. Now that can work the opposite direction when home prices fall, but for now, over the last decade, moving in a positive direction. So a lot of equity built up in people's homes, and there's people talking about, well, this is equity that people can potentially tap into if there's a recession or people need it in terms of getting a home equity line of credit or something else. But we're just in an unprecedented position in terms of 35 trillion of this home equity value. We've never seen anything close to that. And if we look at the assets in money market funds, interesting on the cash side, well, they've tripled over the last decade. 7.4 trillion hitting a record high recently. So Americans seem like they have a lot of cash and they have a lot of equity in their home. Now, the interesting thing is looking at the changes since 2000 of the two, the home equity and financial assets, so things like stocks. And you could see the home equity boom, the housing bubble created huge home equity. Then you had the crash in the housing market. You could see home equity values going down, bottoming in 2012. But since then, racing back to the upside, and again, because of that leverage component, and now far exceeding where they were back at the peak during the last housing bubble. So what I've called this is a second housing bubble in the US. There's no way to argue, I think, it otherwise, just looking at the affordability picture, looking at home prices relative to people's incomes. We're in excess of where we were back during the last housing bubble. And since 2000, we see home equity increasing 389% versus 263% for financial assets. I don't think there's any reason to believe that gap is sustainable in the long run. And I'm going to come back to just a few things here. Number one being affordability here, 89% increase in what you would need to buy the median priced home. That today, this is going to be your median housing payment. So 5 years ago, it was $14.84 a month. Now it's $28.10 a month. So 89% increase in 5 years. Clearly, people's incomes have not gone up anywhere near 89%. And what that's causing is this enormous affordability gap between what people's actual median incomes are, household incomes a little bit below 80,000, what they would need to afford a new home is over 120,000. This gap is a record high 57% gap. So what I argued in a recent video on home price appreciation is the first 5 years of this decade are not going to look like the next 5 years. We're going to see much slower pace of appreciation on both a nominal and real basis. And if history is any guide, we're likely to see the returns on a real basis, the appreciation on a real basis, actually go down because we've gone up so much above the rate of inflation in the first half of this decade and the last decade that it doesn't make sense for that gap to continue going forward. It's simply there's no fundamental reason, and eventually there'll be an equilibrium between supply and demand that will get us to that place. And on that point, we're slowly seeing here, it is very slow, but we are seeing supply come back on the market. We now have over a million home listings according to Redfin in the US. That's a 12% increase over the past year. We're not at the point where that's causing national price declines, but it is at the point where it's causing appreciation to go way down. We're in low single digit territory. And in some areas, if you look at Florida and Texas, where we have big supply coming onto the market, you're actually seeing prices flat to down on a year-over-year basis. So the expectation for the next few years for the housing market, I would say, should be very, very low in terms of expected appreciation, which is another way of saying the housing market is very overvalued if we look at it overall. And one way to look at it, that was what the market is saying that overvaluation is. And we have two comps here: American Homes for Rent and Invitation Homes. These are two public companies that buy single family homes, and what their net asset value is trading at, what their share price is trading at as in relation to the net asset value is a big discount here between 20 to 30%. So what this would argue, if you believe this metric, is that home prices are 20 to 30% above their fair value. And when will we get there? How will we get there? Nobody knows the answer to that, but I think it's an interesting way to look at it. I don't think it's unreasonable to say that if prices came down 20 to 30% nationally, that would help with the affordability picture. That would bring you back more towards normal levels in terms of home prices to incomes, the relationship between the two, which over the long run, absent outside forces, the two have to conform to each other, because a house has to be affordable based on someone's income in the long run. In the short run, you can have manipulation, you can have the Fed driving mortgage rates down on an artificial basis, you can have supply shocks like we're seeing today, but in the long run, home prices have to be in relation to people's incomes, and that should make sense intuitively. So the question for this year, I think, will be, the big question is, if we do see economic weakness, what impact that's going to have in terms of the housing market. We didn't really see it in 2020 because it happened too quick, and the unemployment picture was clouded by the fact that many people who lost their jobs were actually being paid more on unemployment because of the additional stimulus and other measures. So we didn't have a true recession in that sense. If we do have a recession this year, which actually sees unemployment rise If we see real wages go down in the US because of that, is that going to put pressure on the housing market? It's too early to tell, but it wouldn't be unreasonable given where the housing market is today. So just like the Mag 7 in terms of valuations entering the year, housing market very elevated, people expecting prices only to go up double digits going forward because that's what they've done in the recent past. So I'd say they're very vulnerable to some type of negative news or negative shock here, which would cause more people to list and more people, more prospective buyers to back out of deals. There was an article in the Wall Street Journal talking about high-end market where people were backing out of deals because the stock market had gone down. Of course, that's a short-term thing. If the stock market bounces back, it might come back into the market, but just shows you the impact that not only the stock market, but the overall economy is likely to have on the housing market. And housing prices are not pricing in right now any type of economic weakness or a big increase in the unemployment rate. Let's end, as we always do, with something positive. That would be the transition from goods to services in the U.S. economy. To me, this is a very positive trend. Hopefully, this continues, and that would be the percentage that U.S. consumers are spending on services versus goods over time. You can see here in 1959, 45% is spent on services, 55% on goods, and today, 69%, which is a record, on services and 31% on goods. Why is this a positive? Why is this a good trend? Well, simply there's only so much you can spend on goods. There's only so many clothes you need, or cars, or other goods. And when you increase your wealth as a household or as a country, well, that allows you to spend an increasing percentage of your salary on services, on travel, on things like that. So experiences over things when you have an increase in wealth over time. So to me, this is just another indicator, and obviously we could simply look at real incomes going way up since 1959, but this is another way of looking at it. The transition in the economy from goods to services just means that the average household, the average person in America is actually in a much better place today than they were in 1959. So we'll end it right there. Thanks everyone for joining me on the Week in Charts. Have a great weekend. Have a happy Easter, happy Passover, and I'll see you next time on the Week in Charts.